Hello and welcome back to KD's Business Tips. In this video, we're going to talk about payroll versus dividends versus shareholder loans. The three main ways you take money out of a business. Now, if you're on payroll yourself as a business owner, you may be experiencing a lot of extra tax for no reason. Now, you may also be paying a lot of extra CPP. It really depends on your situation because in some situations, payroll is a good thing. Now, payroll can include a salary, it can be an hourly thing, it can be a bonus, and so forth. Either way, it's still payroll where deductions are paid to the government in advance. So basically, you're paying your taxes in advance, of course, as you go. Now, payroll is good in some circumstances, especially if you need credit, if you have trouble managing your tax money. But other than that, typically, you're not going to want to use payroll as a business owner, but you may also have employees on payroll. Now, the second area is dividends. Dividends are simply a payment after tax from the profits of the company. Whatever the profits and the sum of the profits since the beginning are the retained earnings, could be profits or losses, okay, minus any dividends nets out the retained earnings. And you can pay dividends up to the amount in the retained earnings. Dividends are simply a payment of profit after tax, and you get a dividend tax credit, which really offsets the tax you already pay in the corporation, so you don't get double taxed personally. Now, dividends are beneficial in a few ways. They make your income on your notice of assessment look higher than it is. It allows you to plan and diversify the way you do it, an income split and so forth. But it depends on your situation. Dividends may or may not be for you. It's all part of the planning. And the last one is shareholder loans. Now, shareholder loans is typically used by many business owners who have corporations because as a shareholder, you can loan the company money or it can loan you money. You can loan it assets, it can loan you assets. Now, there are rules around that, but basically in a nutshell, if you draw out of your company, that can be considered a shareholder loan and you can claim it as wages or dividends later. Payroll or dividends later. You have that choice. You don't have to claim it now. So you can use that shareholder draw. Also, if you put assets into your company or money, you pay for things in your company, you can then take that money back out tax-free and not have to claim it on your tax. So the shareholder loan is really a powerful tool, and it's an area that you can really utilize in your strategic planning when it comes to your taxes and your business planning. If you have questions on this, these are simple summary videos, but of course we can go in much more depth. If you'd like to hear from us, we'd like to hear from you. Thanks for being a part of KD's Business Tips, and we'll see you in the next video.